This is not a story about a silver rally. It is a system story. Most people look at silver the wrong way. They think it is just gold with more volatility, a more speculative trade, a faster way to chase upside, but that view is too shallow for the environment we are moving into. Silver is not moving because traders suddenly got interested in metals. It is moving because two very different pressures are starting to collide. Monetary distrust on one side, industrial necessity on the other. And when those two forces tighten at the same time, silver stops acting like a side trade. It starts acting like a signal that points to a much larger shift in the financial system, the kind of shift Ray Dalio has been warning about for years. The foundational problem is simple. The money in your bank account is not stable wealth. It is a nominal claim inside a system that survives by issuing more debt, more currency, and more promises against the future. Most people do not think about wealth that way. They think in nominal terms. Their salary is up, their house is up, their portfolio is up, but if the purchasing power of the currency is being diluted faster than they realize, then what looks like progress may actually be erosion. That is the quiet mechanism underneath this story. Currency debasement. And currency debasement rarely arrives with one dramatic announcement. It usually comes slowly. A long repricing of what your cash can buy. A long repricing of what your savings are worth. A long repricing of what gains actually mean in real terms. This is not fear, it is arithmetic. So why does this matter now? Because heavily indebted systems do not usually choose the clean solution. When governments have too much debt, too many future obligations, and too little political appetite for austerity, they tend to choose the tolerable path. And the tolerable path is usually some form of devaluation, not because policymakers want chaos, because arithmetic starts closing off the alternatives. That is one of the most important ideas in Dalio's long-term debt cycle framework. When debt grows faster than income for long enough and the system controls its own currency, policymakers eventually lean on money creation, suppressed real yields, and financial repression to reduce the real burden of debt. That may stabilize the system politically, but it punishes savers financially. And that is where precious metals come back into focus. Gold usually gets attention first. That makes sense. Gold is primarily a monetary asset. It is where central banks go for reserve diversification and monetary insurance. But silver is different. Silver has a dual identity. It is a monetary metal, and it is a critical industrial input that changes everything. Gold can rise because trust in money falls. Silver can rise because trust falls and physical demand tightens. That is not a small distinction. That is the whole setup. Because silver is tied to two forces at once. The first is monetary distrust. The second is industrial necessity. And when both are rising together, silver enters a very different kind of regime. If you want more analysis that focuses on the mechanism instead of the headlines, subscribe. This channel is built for people who want to understand what is really driving the market. This is where most commentary breaks down. A lot of people still treat silver like a high-beta version of gold, and at the surface that is partly true. Silver is smaller, more volatile, more sensitive to liquidation, but that only explains the price action. It does not explain the structure underneath the price, because the real economy needs silver. Silver is embedded in electronics, industrial systems, power infrastructure, and solar technology. The world uses silver because it has to. Not because investors are optimistic, not because traders want a narrative, because it serves a real function in modern production. And supply does not instantly rise just because price rises. Mine output responds slowly. New production takes time. And unlike gold, a meaningful amount of silver is consumed in ways that are difficult or uneconomic to recover. That creates a very different setup. Silver does not rely purely on investor enthusiasm. It has a second engine. This is where most investors make the mistake. They buy silver for the upside, but they do not prepare for the volatility. They treat it like a short-term trade instead of a position inside a bigger macro thesis. Then the first drawdown hits. Liquidity tightens, volatility spikes, silver gets sold with everything else, and they lose conviction because they never really understood what they owned in the first place. That is the mindset error. Silver is not compelling because it goes straight up. It is compelling because the system underneath it is becoming more fragile, more indebted, and more inflation-sensitive. In a real liquidity event, silver can absolutely fall. We have seen that before. Forced selling does not ask what is valuable. It asks what can be sold. But that is not the right long-term test. The bigger question is whether the world is becoming more supportive of the conditions that make silver strategically important. And right now the answer appears to be yes. Debt is higher, fiscal pressure is higher, geopolitical trust is lower, industrial demand is stronger, and central banks themselves are already signaling that monetary neutrality is gone. That is what most people miss. They keep looking for the silver story inside the silver market. But the real silver story is happening outside it. It is happening in deficits, in bond markets, in reserve diversification, in industrial policy, in energy infrastructure, in the quiet recognition that the old financial order is becoming more unstable and more politically managed. That is the signal. So the question is no longer, can silver go up? The real question is this: what kind of world makes silver necessary? A world where paper claims are less trusted. A world where governments need softer forms of default through devaluation, and a world where industrial systems need more real material even as monetary systems become less credible. That world is already taking shape. So what should investors watch now? Watch real yields, watch inflation persistence, watch widening fiscal deficits, watch central bank behaviour in gold, watch industrial demand in silver-heavy sectors, watch the dollar for confidence, not just direction, and watch the bond market, because that is where policy constraint shows up first. Because the next phase will not be defined by headlines, it will be defined by constraint. Here is the bottom line: silver is not just a commodity, and it is not just a trade, it is a signal that monetary trust may be weakening, a signal that debt-heavy systems are drifting toward devaluation, and a signal that one of the few tangible assets with both monetary history and industrial necessity may be moving into a much more strategic role than most investors realize. This is not about chasing a price target, it is about understanding the regime. Because when the regime changes, the assets that matter change with it. And silver may be one of the clearest warnings that this shift is already in motion. What signal are you watching most closely in the market? Right now, let me know in the comments. And if you want more analysis that focuses on mechanism instead of headlines, subscribe.